30-year rates are basically saying, if you're not hiking rates, then we are hiking rates. And that's why 30-year rates have just made it much more expensive to borrow, to buy a house. And as a result of that, financial conditions are tightening. Right. And he didn't tighten financial conditions, but the market decided to say, well, then we think it's time to tighten financial conditions.
And John, I know you've got a question. The key thing to me, John, is 30-year rates, 520 is a key print. We're at 517. 520 is an OMG print.
The price of volatility, is that what we're learning? The price of reducing guidance, reducing communication, being very, very unclear about what on earth they're going to do with policy. Are we paying the price this morning and this afternoon?
But that's why the task forces will be very, very interesting, because they will certainly also, on the communication task force, they will have to discuss what is the best approach. Is it the best approach to have no forward guidance? Is it a better approach to have forward guidance? If you do not have forward guidance, you do have more volatility. But in fairness to Kevin Warsh's point, he did say that, well, when we don't say anything, markets are reacting to the data as we go along. But the risk, of course, is that if the market is overreacting to some data, that then also needs to be resolved in the task force on communication, namely, is that the right way to do it? Because it runs the risk, as you're saying, John, that you will have more volatility.
Torsten, thrilled to have you here with this really odd press conference. There was a bombshell in there where he went back to 2014 in a paper he did on the Lucas critique. It's just slipped in there for a second. But to academic economists, that is a bombshell, what he said. And what he's basically saying is the distrust that Robert Lucas, the laureate, had of models. Are we, I think of Claudia Sam, Lisa, you mentioned this earlier, the idea of reaction functions. Is this a new, almost model-free Federal Reserve away to Lucas and even away from the giant Olivia Blanchard?
It does lean into the Chicago Stanford school of thinking, namely that when you have a policy that you're changing, you should not run regressions and look historically at the data up to where we are now, because the change in the policy is going to change how people behave.
Is there a new model then? Is there a new fresh Warsh model we need to discover?
Yeah, because I think he's saying that you can't just look at all the models that look back, because when we are now changing policy, then forward-looking, people are going to change behavior.
And how do you determine an inflation rate across that? If you take DSGE, Richard Clare or Gertler or Brown, if you take the mathematics of that, throw it out the window for this show. But the bottom line is inflation is the measurement we use. How will we measure inflation with a new Warsh-Lucas model?
But that's exactly right, Tom. That's why if you don't have the models that look at the latest data, then what are you then looking at? What are you then relying on for forecasting what inflation will do going forward? So in other words, if I'm not allowed to look backwards and say this is where the data is coming from and the trend is whatever this or that, well, then what am I then using as the guidepost for thinking about what inflation will do going forward?
Was that
10 basis point move on 30s. There it is. Wow. Almost higher by 11 basis points and closing in on 519. I'm thinking of all the people that would be unhappy with this news conference in the last 60 minutes. Forget market participants. Imagine being at the Treasury right now and you're Scott Besson and you're seeing yields go higher on 10s, materially higher on 30s. And then I'm thinking about the others on the committee. I'm not an establishment guy. I'm very, very happy to blow things up and have a new era. I've got no problem with that. I'm open to new ideas. But I just wonder how offended some of the sitting officials might be by how patronising much of that news conference was over the last 60 minutes.
Well, it's clear that the sitting committee that he came into had already thought about basically all areas of the task forces before. So it's clear that the market here is saying, well, if we now are getting a day with a no hike, well, then the long end, of course, is moving, basically telling you that, well, this is all about credibility. Are you really going to follow through on inflation? And that's, of course, the thing that the FOMC needs to go home and think about now. The market reaction speaks very clearly that now we need to talk about what is the credibility of the committee, because it cannot only be talk. You will eventually have to follow through. And that's why the probability, given this market reaction now, has gone up quite significantly that they will have to move at the next meeting.
But this is really important. In other words, you're saying that the reaction, the long end of the yield curve, is a challenge to the credibility of this Federal Reserve and will force their hand. That if they do not hike rates in September, you will see some sort of unmooring of long-term yields.
Yeah, because the risk is if you keep on just talking tough, 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 and therefore markets end up saying, well, this is just a lot of talk, and you don't deliver on that tough talk, the risk is, of course, that the long end will say, well, if you don't deliver, we worry that you are implicitly allowing inflation to be higher, despite the talk about not allowing inflation to be higher. And that is indeed a question about the ultimate credibility. Is the committee ready to vote next time time. This was not only Kevin Warsh, this was 9 members who voted to keep interest rates constant at this meeting. So at the next meeting, many of them must look at the reaction today and come to the conclusion, if we want to keep our credibility, we do have to move to make sure that inflation comes down, and therefore ultimately long rates also begin to go down.